Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Enable Midstream Partners stock and analyzing its financial ratios. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation for a stock of your choice, or support the channel, you can become a member by clicking on the link in the description below. Enable is an oil and gas midstream company. Midstream refers to points in the oil production process that fall between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. Let's get started with the model. This is a mid-cap company. Their market cap is $2.1 billion. That's the value of the company according to the stock market. And they're trading at $4.80 a share, and they have 438 million shares outstanding. To calculate shares outstanding, it's market cap divided by stock price gives you shares outstanding. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows, and then you discount that back to today's dollars. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Capital expenditures are investments in property, plant, and equipment. And if a company has positive free cash flow, it has the ability to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things. This company has positive and pretty healthy free cash flow each year. It does take a dip in 2018, but it's pretty high in the other years. Net income is the profit and loss on the income statement. It's revenue minus expenses. Their net income looks pretty consistent from $300 to $500 million a year. In 2018, they had the highest net income, yet their lowest free cash flow. Revenue is a sales for the company. That's the top line of the income statement, and their revenue grows a lot from 2016 to 2018, then dips in 2019. They have pretty healthy and consistent net profit margins. Net profit margins is net income divided by revenue, and they're 13 to 16%. The higher the expenses, the lower the net income and the lower the net profit margin. So this company converted 13% of its revenue into profit in 2019. That means 87% went towards expenses. I like to see free cash flow at or above net income because free cash flow takes net income and adds back non-cash items. If free cash flow is a lot lower than net income, it's probably investments in capital expenditures. But let's look at the financial statements. This is a statement of cash flows, and to calculate free cash flow, it's cash flow from operations. In 2018, it was $924 million minus capital expenditures. And they invested $728 million into their business that year. That's why their free cash flow was so much lower in 2018. You can see in other years, they didn't invest that much into their business. It's between $380 million and $430 million. A couple of things to think about when a company invests a lot of money into capital expenditures. One thing is you want a return on that investment. So if you're investing X amount of money into your business, you want a return greater than X. Another thing to think about is opportunity cost. Would the money be better used in a different area? These are just a couple of things to think about when you're analyzing a company. So to calculate cash flow from operations, you start with net income, and then you add back the non-cash items on the income statement, and then you adjust for working capital, accounts receivable, accounts payable. In 2019, they had $400 million of net income and $942 million of operating cash flow. In 2018, they had $523 million in net income, which is a lot more than 2019, but lower operating cash flow. A big reason for the lower net income in 2019 was because they passed through an $86 million goodwill impairment. In Yahoo Finance, you can tell what type of impairment it is, whether it's goodwill or an impairment of a fixed asset. I copied this from their 10K. It mentions the $86 million goodwill impairment on Anadarko Basin. Goodwill is a non-current asset on the balance sheet. The way goodwill comes about is when you pay a premium for a company when you acquire it. So say for instance, you paid $10 billion for a company, but it was only worth $9 billion. That means you would take $1 billion, the amount you paid above what it's worth, and put it onto the balance sheet as goodwill. Now you might be asking, how do you know how much a company's worth? It's actually pretty easy. You just look at the equity section of the balance sheet. So this company is worth $7.4 billion according to the balance sheet. Another way to calculate equity is assets minus liabilities. So if this company was acquired today for $8.4 billion, the company that acquired it would have to book $1 billion onto its balance sheet as goodwill. It would also have to take all the assets from Enable's balance sheet and put it onto theirs, and the liabilities from Enable's balance sheet and put it onto theirs. But since they paid $1 billion more than what the company's worth, they would have to put that somewhere, and that goes to goodwill. Tangible assets like machinery are depreciated on a balance sheet, so their value goes down over time. Intangible assets like patents are amortized. Goodwill is an intangible asset, but it's not amortized. Each company has to test for goodwill impairment each year to see if it should reduce the balance of its goodwill. Enable acquired Andarko in the past, so each year it has to test for impairment. In 2019, Enable Midstream concluded that the value of Andarko should go down $86 million on its balance sheet. So what it does is it takes $86 million off of the goodwill on the balance sheet and passes it onto the income statement as an expense. So on the income statement, you could see the negative $86 million. But if you look on the statement of cash flows, they add back the $86 million because that's a non-cash item. The cash happened years ago when they acquired a company, so anytime they impair the asset, it's a non-cash item. Let's look at the capital structure. $4.4 billion of debt, $925 million of equity, and they pay 4.3% interest on their debt. Enable does not pay taxes because it's a master limited partnership. In order to become an MLP, the business must receive 90% or more of its revenue from natural resources or real estate. This company receives its revenue from natural resources. An MLP issues units and not shares, so they have no equity on their balance sheet. In order to calculate the equity, I took total assets minus total liabilities on the balance sheet. So they're a bit leveraged. 83% of the capital structure is debt, which means there's 17% equity. Cost of equity is 22.9%, and to calculate cost of equity, we use a capital asset pricing model. And part of the CAPM formula is the beta, and they have a really high beta, 2.68. Beta is a measure of a stock's volatility in relation to the overall market. The S&P 500 has a beta of 1. This stock has a beta of 2.68, so if the S&P goes up 1% in a given time frame, this stock should go up 2.68%. And if the S&P goes down 1%, this stock should go down 2.68%. Beta is calculated using regression analysis. Regression analysis allows you to examine the relationship between two or more variables. Beta is systematic risk related to the market, such as external factors like interest rate changes, policy changes, wars, etc. Systematic risk cannot be diversified away. Unsystematic risk is the risk of an individual company, which can be diversified away by adding more companies to your portfolio. And their WACC is 7.58%, which is a blend of the cost of debt and cost of equity. And the WACC is a discount rate companies use when they want to take on new projects. So for example, if a new project came along and it cost $1 million upfront for the company to take on the project, but they would receive $100,000 a year in cash flows over the next 20 years, what they would do is they would discount those 20 years of cash flows back to today using the weighted average cost of capital. And if the value of those 20 years of cash flows in today's dollars was $1.5 million, they would take on the project. Since it cost $1 million, they'd be making $500,000. But if they discounted those 20 years of cash flows and it was $800,000, they would not take on a project. Since it cost $1 million, they would be losing $200,000, and you only want to take on projects that add value to the company. And the WACC is a discount rate we're going to apply to the future cash flows for this model. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $2.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $4.3 billion. We divide that by 438 million shares. And we get a calculated stock price of $9.72. They're trading at $4.80, so they're trading at a 51% discount. It's a really strong buy according to the model. Simply Wall Street is pretty close to me. They're at $10.33 a share, so they're also saying it's pretty undervalued, the stock. Simply Wall Street's value is based off of the average analyst estimate. Let's see where the stock has been trading the past few years. The stock peaked at $16 or $17, but it's been coming down quite a bit the past year. So this looks like a really great value. They were paying about 32-33 cent dividend for several years, but cut it down to 16.5 cents in May of this year. They probably cut the dividend to be more in line with the stock price. Their dividend yield is 14%, so they do pay a really nice dividend. As the stock price goes up, the dividend yield goes down. And as the stock price goes down, the dividend yield goes up, because stock price is part of the dividend yield formula. It's good to understand that the stock price movements are not directly related to how well a company is doing financially. It's just a function of the stock price. The only thing that directly corresponds to the stock price movements is supply and demand of the market. The more people that want to buy a stock, it will push the price higher. And the more people that want to sell a stock, it will push the price lower. Because sometimes you see companies reporting really poor financials, but their stock price keeps going up. And other companies report really great financials, but their stock price keeps going down. The market is forward thinking. So part of investing is understanding market sentiment and psychology of investors. Let's look at their financial ratios. They have really good price multiple ratios because their stock prices come down so much. PE is really good. The median for the market is 16.2, the average is 18.1. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 5.3, so investors are paying $5.30 for $1 of earnings. Price to sales is also really good. The median is 2.0, the average is 4.7. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 0.7, so investors are paying 70 cents for $1 revenue. Price to book is also really good. The median in the market is 2.3, the average is 4.9. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5, they're at 2.3, so investors are paying $2.30 for $1 book value. Equity is total assets minus total liabilities on a balance sheet. A good interest coverage ratio, the median is 4.0, the average is 13.0. Interest coverage ratio is EBIT over interest expense. I like to see above 2, they're at 3.4, so they can easily cover their interest payments. EBIT is earnings before interest and taxes. It's called operating income on the income statement. Really good ROE, the median is 12%, the average is 13%. ROE is net income over equity. I like to see above 20%, they're at 43%. So they provide great value to the equity holders. To have a really good ROE, it helps to have a lot of debt because it lowers the equity. Bad current ratio, the median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 0.5, so they could only cover 50% of their current liabilities, which means they may need to take on more debt. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The best way to look at ratios is to compare them to similar companies. I've done videos on 26 oil and gas midstream companies, and Able is right here. And if they have a number in green, they're better than the average. If they have a number in red, they're worse than the average. So the average is down here. So PE, they're better than the average at 5.3, the average is 8.5. Price to sales, they're a lot better than the average at 0.7. Price to book, they're also doing much better. Although in current ratio, they're struggling, which isn't good. ROE, they're much better than the average at 43%. Average is only 10%. This industry doesn't provide a good return. They have a lot of debt at 83%, much higher than the average. And they're a small company, 2.1 billion market cap. The average is 10 billion. And they pay a 14% dividend. The average is 12%. So this industry pays a huge dividend. So to summarize, I have them trading at a 51% discount because their stock price has come down so much. Their ratios look decent and their financials look really good. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation for a stock of your choice, or support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.